Welcome to the Daily Brief, where I'll go over the action in the market for Thursday, January 12th, and then we'll see how things look for Friday, January 13th. And we had an up day. The market was fairly receptive to the CPI report that came out. Some parts came in as expected, others showed that things are getting a little bit under control. It wasn't the real gangbuster day. We didn't just shoot to the moon after the report came out. But the fact that we didn't see a lot of selling take place to this point, and that the market reacted generally in a favorable way, is adding to this positive backdrop that we're seeing. So let's go back and talk about what happened and show that the market continues to improve. We're not out of the woods yet. We're never out of the woods, but at least we use all of our charts to give us the probability of what is happening right now, and it is turning more positive. So right at the open, we did have a higher open. It wasn't a real gap. The futures, right after the report came out, they initially shot down and then worked their way back up. And by the time the stock market opened, we didn't have a real gap, but there was a positive open. We went up to R1 at 39.84. And then there was a little bit of a decline, very common for this to happen. We went down below the daily pivot at 38.56. And then we went all the way down to S1 at 39.42. Then prices for at least the morning part of the session, they stayed in a range between S1 and R1. So again, this is why these pivot levels are very important. We can really use them as guideposts. As the day went on, prices moved around the unchanged level. So there was a real non-committal. It really came later in the day. Eventually, we climbed above R1 again and got all the way up to R2 at 39.98. That's really close to that 4,000 level. But then we came down a little bit and we closed at about R1. We were up 0.34%. Volume was above average, so we saw that pick up slightly. The technicals, as I said, and I'll show you with a lot of charts, is they are showing a real improvement on all the different time frames, but we're still getting a little bit deeper into an extreme positive situation, especially in the short term, and we're starting to see a few clues of that into the intermediate time frame, and it's all to do with inflation and interest rates. Here is the daily chart where we did have a higher open, but not a real big gap. We went all the way up to R1 initially, then came down to S1, then kind of chopped our way back up to R1, came back down. This dashed line, this is the unchanged level, and we spent quite a bit of time along there. And then we started to go higher, made it all the way up to R2. A little bit of selling came in, but they quickly bounced back, went back up to R2. Saw some declines going into the close, but then a nice green bar that took us right back up to R1. So what are some comments? The stock and bond markets, they believe that the Fed will pause rate hikes sooner rather than later. Doesn't matter if there's really no evidence for this. There's really, that I've been able to find, no evidence from the Fed. There's really no statements. If anything, the Fed officials that have been talking are not necessarily saying this. It's the scenario that for about a year now, the market has latched onto, even when there's very little evidence to do so. And as long as they latch onto that, we have a more positive environment. And then if the Fed comes out and says, no, we're not going to do anything like that, or if we hit some resistance in a real overbought situation, then we might see things shift and go the other way. But for right now, the market is a little more upbeat with its view of inflation. We did have a little bit of Fed speak where St. Louis Fed President Bullard, who's now not a voting member, said that he thinks that the Fed should get rates above 5% quickly. Just get them right up there. And there are a lot of economists and some podcasts that I listen to that said, why are we doing this incrementally? We need to shoot interest rates up really quick, get them up there, and then bring inflation down and then start to lower interest rates. And you can make a case for either side. There's a side that says, no, it would be too much too soon for the economy and it would freak everybody out and the market would totally tank. Let's just do it incrementally and that will have less of an impact. Well, the Boulard here said that we should get right up to 5% and then hold them at that level, but the markets really didn't react to that. That's kind of known news right now. The market knows that this is going to happen, so it wasn't anything really new. Then on Friday, there will be a lot of bank earnings reports that will come out, so that could have an impact on how things behave. The S&P has regained its 200-day simple moving average at about 39.84, depending on how you calculate this. So we're pretty much right at that level right now. But so there's still this line in the sand. There's still this idea that we've gone right up to resistance. And we also have that downtrend line that every day it's coming down a little bit. It's right around the 4,000 level, and that's still slightly above where we're at right now. Then the VIX to the S&P 500, the correlation, it's still continuing to decline. The VIX is still acting kind of strange. Now I'm focusing more on that correlation chart, and I'll show you that after it really was giving us an extreme positive reading. The dollar did decline, and the dollar I have a couple charts to show you. We're in a downtrend now with the dollar, and interest rates were also down. We also saw another good day with copper, and I have a chart to show you that. In the short term, our stochastic, Stoch RSI, Williams percent R, those are the ones that have been on this list for a few days now. We also have the rate of change going back 5 periods. It's starting to look extreme. We're seeing a few more things added to the intermediate term overbought condition, the CCI 14, the moving average study, the McClellan oscillator, those have been on there for a couple of days now, but we also added the rate of change going back 10 periods. And the rate of change just says, okay, the price right now, and then for the 5 period, it looks back 5 days and compares those two prices. With the 10-day right now, it looks back 10 days. Well, we spent quite a bit of time in that sideways range. So to go back and look a certain number of days, it looks like it's been a pretty big change, when really, if you look at the overall chart, yeah, we're showing some improvement, but it's not as drastic as some of these indicators are showing to us right now. And that's the problem when we're in a sideways trendless environment. We shoot up, we shoot down, we quickly get to some extreme readings with a lot of our indicators. Long term, we still have some of our moving average studies that are improving, but starting to get extreme positive. The 30 to the 5 is still not inverted right now, but the other yield curves that we follow are, and I have a chart of the 10 to the 3 month to show you, because that's just getting more and more inverted as time goes by. Sentiment has switched over to positive with the update. We're no longer neutral. We're giving a reading of 57 now. You could say that's getting into greed territory. I choose to call this positive until we get really, really positive. That's when we get extreme. So it's not extreme right now. So we can go with sentiment at this point. We don't use this as a contrary indicator until it gets really extreme. The CPI, and I'll go through that on the next slide. We also had weekly jobless claims, and because the employment situation is so important, there's a lot more charts that I'm going to start showing you, because that's the real holdout with why the Fed continues to raise interest rates. And yeah, inflation is coming down, but for a whole generation, they've never seen inflation this high. And for a lot of money managers, they've never had to deal with a high inflationary environment like we have right now. I grew up in the 70s, so I'm really aware. And into the 80s, inflation was all we thought about and talked about. Well, we did other things, but we knew what it was like to go through that kind of an environment. Well, because the employment situation is such a big deal now, and it's still holding up, I'm going to keep an eye on that, and we're going to start to see if there are weakness areas that begin to develop. But for the weekly jobless claims that came in at 205,000, that's less than the 210,000 they expected, and it's just a little bit less than what we had last week at 206,000. Our trend is still positive with the green line on top. It's above the moving average, so it's starting to strengthen, but we're still below 20. Again, you will have to decide. Do you want to pick this up as a trend right now, or do you need more confirmation that we're coming into a trending environment? Our bias is positive with the update, and our momentum is positive. Here's some information about the CPI. The headline number, it came in down 0.1%. They expected it to be unchanged. The last time we had this report, it was up 0.1%. And the CPI showed continued disinflation. That means inflation is coming down in the total CPI, where inflation on a yearly basis had been at 7.1%. Now it's coming down to 6.5%. Still very, very high, and still way above the 2% range that the Fed is targeting, but at least it's coming down, and the market liked that. When you take out the food and energy, of course, the things that you have to have, that's called the core CPI. It was up 0.3% as expected, a little bit more than the last report where it was up 0.2%. And on a year-over-year basis, it's actually going up a little bit. It's at 6% on a yearly basis, where last time it was at 5.7%. And then services inflation. These are not the manufactured goods, but the things that we need to go out and have done for us. This situation did not improve. It was up 7.5%. Last time it was up 7.2%. And that's part of the worry that was coming into the market. Then if you take out rent of shelter, just rent that people have to pay, of course, where are you going to live? But this is trying to get you a more stable number, because that can really fluctuate. On a year-over-year basis, services increased 7.4%, where last time it was at 7.3%. And then you take out medical care services. Yeah, just you're sick, you don't need to go to the doctor. You can wait for that operation. Inflation was still up 8%, where last time it was up 7.6%. Here is from shadowstats.com. What they have done over the years is they recalculate the way that they give us the CPI number, and this red or yellow, orange, what have you. This is the official number that they gave us, and it's right now at 6.5%. If we go back to the way it was calculated in 1990, we would be at about 10% inflation. That's not the scary part. This next one is the scary part. If we go back to how they calculated in 1980, we're just under 15% inflation right now. That's the blue compared to the red line. That's the official number that they gave to us. Another thing that I ran across is this Michael J. Kramer. That was the Twitter handle that I couldn't remember. And right below his name, if you use Twitter, this is how you can start following him if you desire. I find some of his charts to be very helpful, and I've been using some of them in the videos, and so I just want to acknowledge his good work. But he kind of posted this jokey looking chart here where it says now the market sees inflation at 2% by June. Okay, yeah, like that's really going to happen. But we just this is the expectation for what inflation is going to do going forward, and it'll be, well, right down here is 2% in June. And that's why he put the LOL there, because it just seems just completely unrealistic. Here's some of the employment data that I'm going to start showing as it's released. This is the weekly jobless claims. This goes back 2 years. So this is 2021 and then 2022 and then coming now into 2023, where we were really coming down after all of the lockdowns. We started to go back up and then coming back down. What we like to do on this, and what economists do, is they put a 4-week moving average on this to kind of smooth it out. And we see that jobless claims have been declining. So that's still suggesting that it's a tight labor market and that the Fed is justified in continuing to raise rates. Another thing that I don't talk about each week, but it's continuing unemployment claims. These are folks that have been on unemployment for a while, and it was declining through 2021 and through a large part of 2022. It was starting to tick back up, but now it's actually dropped below the 4-week simple moving average there. So this is just suggesting that there's not a lot of weakness yet coming into the employment situation. Now, these are the official reports that they give us. There's all kinds of other reports that could contradict this, but this is what the market uses. This is what the media likes to tout. And so this is what we use, knowing that it may not always be a very realistic representation of what's happening. Another thing I ran across it was in a podcast or something. Somebody made a post, and they just talked about the personal savings rate. And so I thought I would include that, where it had been around 10% all the way up to 15%. If you go back into the 60s, then as economic times get tougher, it starts to decline. Well, what I'm focusing on is over on the right. This is all the stimulus checks. A lot of people put that into savings, but look at how the personal savings rate has really been declining. Now, this is old already. This goes back to December 23rd, but this could be difficult, not only for you personally, but for everybody, because they were living off of savings as inflation was going up. Well, this is showing that a lot of the savings are now dried up. And then what are they going to do? They had to pull out their savings to get gas, to buy food, to do the things that they need to do. And if that savings is gone, what are they going to do after that? Well, they might have to start using more credit, because we're seeing credit card debt really on the rise right now. And that could feed in more to the personal situation of what folks are going through. And I'll keep an eye on this. And if we see this really start to change, I'll bring that to your attention. This is a chart that I have been showing. The white line just suggests that the earnings per share has been coming down, especially through the last half of 2022. And that's why the justification is there for stock prices to go down. This is another chart where we had been using 2006 through 2008. Now, the current model looks closer to the 1998 through 2002 model. And if we continue to follow that, we should see some weakness going forward. Now, right now, we're in a positive situation. So it looks like the market is starting to improve. If it does, then it may negate what this previous price pattern is trying to tell us. We also had the weekly American Association of Individual Investors. Their survey came out. They had been extreme negative. Well, in the latest survey, and this is about a week old now, it did show some improvement, but they're still pretty negative overall. When we get to an extreme reading, we use this as a contrary indicator, but usually what we see are spikes going down that oftentimes correspond to a low in the S&P. Well, we just have a whole jumbled mess here where we came down here quite a bit in 2022. So it's not as cut and dry as usually this indicator would suggest. This is the VIX to S&P 500 correlation. After spiking up, it is starting to come down. So will that give some support to the S&P to go higher? These red lines also show these other spikes and then what the S&P did after that. And to a large degree, there was some weakness, but there was also some real strength that developed after we had an extreme reading here. So for right now, if we continue going up, if we can get through this upper resistance and stay above it, and especially in Friday session, close above it, because that'll help the weekly charts look a lot better, then we might default to the idea that this spike and then this retreat could help the S&P go up. Now, we have a rough day on Friday. The banks come out with terrible earnings reports. Something happens that we're not necessarily anticipating. There's a large amount of volume that comes in and they're all doing a bunch of selling. That could wipe this whole positive scenario off the table. But we have to go with what we see right now. The Ulster Index, which measures fear in the market, has also been declining as the market's been going up. We're below this moving average, which is about the midpoint. So it's actually getting a little bit more greed, because you look at other times when it got down to this level, and that often marked a bottom with this indicator. So just a little warning sign. The equity put call ratio declined a little bit in Thursday's session with the up day, not necessarily surprising. Here is the spike that we're working off of after we were going sideways. Is this enough of a decline to suggest that the S&P is going to continue climbing? And then here's the long-term chart where we're down below the red line now that could be providing some support. Another thing, I haven't brought up the VIX chart very much because it really hasn't been doing all that much. Well, with the upward movement in Thursday's session, the line chart and the bar chart, we've now dropped below 20. And so now we're getting into a very non-fearful environment as far as the VIX is concerned. That just means that folks are getting more complacent. The idea is when the VIX is high, it's time to buy because there's a lot of fear. When the VIX is low, it's time to go. And we're getting a very low reading now with the VIX, so just be aware of this. But that's why I've been showing these other charts, the ratio, because the VIX has been acting weird. Well, now we're getting to the point where the VIX is actually registering kind of an extreme complacent reading. So just be aware of that. Then the rate of change going back 5 periods, it is starting to get extreme positive. Going back 10 periods, just barely getting extreme positive. Our trend starting to turn back up. And as I said in yesterday's video, if you're more aggressive and if you like what you're seeing in the chart pattern, you might suggest that we're in an uptrend right now because the green line's on top. If you're a little more conservative with this, if you want to get more confirmation, you will want to see this go up and possibly go above 20 and still have the green line on top before you think that we're in a trend. So this is going to be more of a personal preference, just what you feel comfortable with. You may start off by just nibbling a little bit, and then if that ends up being profitable, maybe add to your position. And then as we're going up, continue to add. That's just another method that a lot of folks use. With our moving average study, looking a little extreme with the 20, 50, and showing improvement with the 200. Stochastic, the short term is extreme. Intermediate short term is extreme, showing improvement with the long short term. Stoch RSI still camped extreme positive. Williams percent R camped positive. CCI 14 still in extreme positive territory, as is the CCI 20. The vortex is still positive, and even with the update, the green line came down a bit and the red line advanced, but it's still positive overall. All of our oscillators now have switched over positive. The short, intermediate, and long-term ones are showing a lot of improvement. So this is just giving more evidence that the market is improving. Here's the PMO, which crossed over positive, and then the two studies down below that actually gave us a couple of days warning or heads up that this was getting ready to cross. With our PMO study, just coming off of an extreme reading with those PMOs that are rising, seeing a real improvement with the buy signals and with those PMOs that are above zero. This takes all the PMOs inside the S&P 500 and fits them together in one study that is then broken down into 3 different categories. The BPI also above 50 and advancing and not extreme, so that's positive. Here we're coming right up to the red line on the daily chart, right at the 200-day moving average. We still have this declining trend line above us. If we do break below that, we do have some longer-term resistance to break above. So the market's really going to have to show some guts and some intense volume if it's really going to end up shooting higher and break through this resistance that we're at. And we're right on that 200-day moving average right now. Swell trading oscillator showing improvement based on price, starting to get a little bit of extreme based on volume. Coming up to the 200-day exponential and simple moving average on our moving average tree chart. And then we're still getting extreme with the CMB composite. This is more of a trading system. The first signal was when we crossed the red line, then that was confirmed by crossing the green line. Well, we can also use this as an oscillator, and it's above this black line. And quite often, if you look back, that is when we started to see some weakness. So just something to be aware of. We're also bumping into this anchored moving average right now as well, which is strange because on other charts, it shows that we're already above this moving average. We're right on the 200-day simple moving average. McClellan oscillator declined just a little bit on an update, but we're getting a little extreme, but we're still positive overall. Summation index advancing based on price and volume with both of these above zero. Here's one I haven't shown in a while. This is the Bollinger Bands, and this is also because we were going sideways for so long. The Bollinger Bands kept getting closer and closer and closer, and then when we see a pretty significant upward move and we hit the upper band, so that may suggest that we're going up a little too far too fast or producing an overbought condition. Seeing some improvement still with the new highs, new lows, with the 5 period and the 10 period. And the advanced decline line, we're just a little bit above this declining moving average right now. If we can stay above that, that would be positive. We're looking more healthy based on price. Advanced decline ratio also advancing, but still not extreme. Accumulation distribution above the moving average and advancing. So that's more positive as well. With the short-term fib levels, we did break through some of these resistance areas, but now we have another one at about the 4,006 level on the short-term fib chart, and we have resistance at the 4,020 level on the long-term fib chart. Here's our longer-term moving average study, looking a little extreme with the 50 and 150, still showing improvement with the 200. Copic curve gave us a recent buy signal that so far appears to be valid. Spring bottom fisher, also a recent buy signal. So that also appears to be valid. We're still declining with our staples ratio to the S&P 500. So this does look fairly viable right now, which could give some support for the S&P to go higher. Doesn't mean we'll go straight up, and it doesn't mean we're going to go up at all. We're just seeing an awful lot of evidence coming together now that is turning things a lot more positive. Here's the chart that I showed for the first time in yesterday's video. This is looking at the home builders, and because this can often be a leading indicator of what's happening. And please watch the video for Thursday, January 12th. I go into more depth. When I show this chart on a daily basis, I'm really just going to focus more on the right-hand side, where we have the S&P has been going up, and we're seeing a convergence with that, a positive convergence, because the home builder ETF is going up. We're seeing the ratio between the home builders and the S&P. That means the home builders are outperforming, so this ratio is going up. And then at the very bottom, the correlation between the two, they're having a tendency to go in the same direction after coming off of a yellow reading where they were not going in the same direction. When you take all of this together, this adds up more to a positive backdrop. But again, please watch that. I don't want these videos to be a total lecture all the time. So once I explain them, I'll try to point that out to you where you can go back and learn about this. And then, of course, I really spend a lot of time on this in my classes when I go through these things. The small cap index, we're just about getting ready to see a golden cross. And we're above the pivot, first of all, and we closed above R1 here. So this is looking better too. And we're seeing some strength in the mid caps, or excuse me, the small caps. The small cap ratio to the S&P is showing improvement. We were going largely sideways, but this is still an uptrend overall with the blue line above the red line. And then copper, after really shooting up in Thursday session, we saw some more follow through in Wednesday session. We saw more follow through in Thursday session. Just want to keep an eye on this, because when this is going up, that generally means a more rosy economic outlook. The dollar, this is where we're running into some problems, and this may also give some support to stocks, where for a lot of 2022, the dollar was just screaming upwards. Well, it's now declining, and we're seeing a death cross on the daily chart. And on the weekly chart, we have also seen a recent death cross as we're now declining. This could also help stocks go higher, because the stock market tends to like a weaker dollar. And then this is the inverted yield curve. This was the 10 to the 3 month. It was the last yield curve to go inverted, and now it's the most drastic one. It just keeps going down and down and down right now. And there's a lot of economists that this is the yield curve that they pay attention to, and this is suggesting that there could be some economic problems, if not a recession, looking forward at some point in the future. So our outlook then for Friday, the market will be closed on Monday for MLK observance. The technicals are turning positive. I haven't changed any of this because there hasn't really been a lot of difference. We're just kind of running the same scenario every day. We have to see more follow through buying. We still have some overhead resistance, and we're becoming overbought in the short term and starting to show a little bit more of an overbought condition in the intermediate term. We have import and export prices coming out, and the consumer sentiment index, that'll probably be the big one. And that comes out about a half hour after the stock market opens. And then there's a lot of earnings that are coming out as well, especially bank earnings in Friday session. And that's probably what the financial media will really be focused on. Then I went ahead and flipped this chart because it's the top part that I'm going to be talking about every day, where when I get down here to the month, quarter, year, that doesn't change as often. So I just wanted to go from top down this way. So if you go from January 2001 to December 2021, January 13th, the Dow was up 47.6% of the time, a little less than 0.5%. The same thing with the S&P, and even a little worse than that with the NASDAQ. So we're not really seeing some kind of historical edge for January 13th. Looking at the January going for the last 23 years, they have been up 43% of the time. They've declined 56% of the time. The quarter, even though this isn't your typical quarter, usually it's January, February, March. Well, this 3-month period is November, December, and January, and this tends to be about the best span of the year. Then yearly, we're still waiting until the end of January to see how the January barometer will play out. And currently, because of the Santa Claus rally and the first 5 trading days, we have a 2.0 score. We'll get the barometer score at the end of January. And then please, I don't want to just keep repeating these things all the time. So you may want to stop and read some of this if you're watching this for the first time. Also likes that we have a mixed government right now, split between Democrat and Republican. Our scenarios, going with the down scenario, not really likely because we're turning positive, but we could be hitting some resistance and we are showing some overbought conditions. Can't really go with the full-blown positive yet unless you're more adventurous, because we're really not trending. The ADX is still well below 20, but we're seeing some improvement in our scenarios, in our rotation, and in our setups. And when I do that new weekly video now, where I go through the charts that I don't show in the videos, I'll probably go through these scenarios just to give you some updates with where they're at, but they're not really generating anything right now. The technicals are turning back more positive. We're regaining some moving average pivot points and fib retracement levels, but we still have some above where we're at. And because the ADX is below 20, even though it's getting stronger and it's positive, we're still in a sideways pattern. So our conclusion, the S&P, it's turning positive. Short term, positive, but becoming overbought. Intermediate term, positive. Just a few little hints of being overbought. Long term, we're right at the 200-day simple moving average, and so it may be improving. If we can get above that moving average and then stay above it, that will help the long-term picture to really improve. Thank you. Have a wonderful day on Friday. I will prepare another brief after Friday's session. It'll be for Tuesday's session since the market's closed on Monday. And then I will also look to prepare the weekly video and the intermarket analysis video, and then I call it the deep dive daily chart video. So have a great Friday, a good 3-day weekend, and I'll talk to you in the next video.